Alright, let's talk about double entry bookkeeping. Imagine it like a set of scales, perfectly balanced. Every financial transaction your business makes has two sides to the story. Double entry bookkeeping is simply a way of recording both sides of every transaction to keep those scales balanced. This system helps you keep track of where your money is coming from and where it's going. It's the backbone of accurate financial reporting for businesses of all sizes. It helps you spot errors, track profitability, and make informed business decisions. Whether you're a small startup or a large corporation, understanding double entry bookkeeping is essential. So let's dive in and break down this seemingly complex system into bite-sized, manageable pieces. Right, let's get down to the nitty-gritty and talk about the key components of double entry bookkeeping. Think of these as the essential tools in your bookkeeping toolkit. First up, we've got the general ledger. This is like your master record book where you record all your financial transactions in chronological order. Imagine it as a detailed diary of your business's financial life. Next, we have the chart of accounts. This is essentially a directory of all your accounts. It's like a filing system that categorizes each transaction based on its type. You'll have accounts for things like cash, sales, expenses, and so on. And finally, no bookkeeping system would be complete without the balance sheet. This crucial financial statement provides a snapshot of your business's assets, liabilities, and equity at a specific point in time. Understanding how they interact is key to mastering double entry bookkeeping. Now that we've covered the key components, let's move on to the fundamental principles that make double entry bookkeeping tick. These principles are the foundation upon which the entire system is built. The first and most crucial principle is dual recording. This is the heart of double entry bookkeeping. Remember the scales we talked about earlier? Every transaction affects at least two accounts. One account is debited and another account is credited with an equal amount. This ensures that the accounting equation always remains balanced. Next, we have the golden rule. Debits and credits must balance. For every debit entry, there must be a corresponding credit entry of equal value. Finally, let's talk about the accounting equation itself. It states that assets are always equal to the sum of liabilities and equity. By understanding and applying these principles, you'll be well on your way to mastering double entry bookkeeping. Let's put our newfound knowledge into practice with a simple example. Imagine you own a small bakery and you just sold a delicious cake for £20 in cash. How would you record this transaction using double entry bookkeeping? Step 1. Identify the accounts affected. In this case, two accounts are affected: cash and sales revenue. Step 2. Determine the type of account. Cash is an asset account, something your business owns, while sales revenue is a revenue account, income earned from selling your goods or services. Step 3. Apply the debit and credit rules. Since you received cash, the cash account will be debited increased by £20. Simultaneously, the sales revenue account will be credited increased by £20. This example illustrates how the dual recording principle ensures that the accounting equation remains balanced. Section 5. Demystifying debits and credits. Debits and credits are the lifeblood of double entry bookkeeping. They might seem a bit confusing at first, but once you understand the basic rules, it all starts to make sense. Debit simply means left, and credit means right. In bookkeeping, these terms don't have any positive or negative connotations. They simply indicate which side of the account the transaction is recorded on. Here's a handy mnemonic to remember the rules. Dead cliques. Debit increases assets, expenses, and drawings. Credit increases liabilities, income, and capital. By understanding these simple rules, you can easily determine which accounts to debit and credit for any given transaction. Section 6. Types of accounts in double entry. In double entry bookkeeping, accounts are categorized based on their nature and how they affect the accounting equation. Understanding these categories is crucial for accurate record keeping. 1. Asset accounts. These represent what your business owns, such as cash, inventory, equipment, and accounts receivable. 2. Liability accounts. These represent what your business owes to others, such as loans payable, accounts payable, and salaries payable. 3. Equity accounts. These represent the owner's stake in the business, including capital contributions, retained earnings, and dividends. 4. Revenue accounts. These track the income generated from your business activities, such as sales revenue, service revenue, and interest income. 5. Expense accounts. These track the costs incurred in running your business, such as rent expense, salaries expense, and utilities expense. Section 7. The accounting equation, ensuring accuracy. The accounting equation is the bedrock of double-entry bookkeeping. This simple yet powerful equation ensures that your books are always balanced, providing a solid foundation for accurate financial reporting. The equation is as follows: assets equals liabilities plus equity. This equation states that the total value of your business's assets must always be equal to the sum of its liabilities and equity. Every transaction you record will affect at least two elements of this equation, but the equation must always remain balanced. This self-balancing mechanism is the beauty of double-entry bookkeeping. Section 8. Double-entry in action practical examples. Let's see how double-entry bookkeeping works in real-world scenarios. You own a clothing store and purchase £500 worth of new inventory on credit. Debit inventory, asset, £500. Credit accounts payable, liability, £500. This transaction increases your assets, inventory, and liabilities, accounts payable, by the same amount, keeping the accounting equation balanced. A customer pays £100 for a previous purchase made on credit. Debit cash, asset, £100. Credit accounts receivable, asset, £100. Section 9. Benefits of double-entry bookkeeping. Double-entry bookkeeping offers numerous benefits for businesses of all sizes. 1. Accurate financial reporting. By recording both sides of every transaction, double-entry bookkeeping provides a more accurate and reliable picture of your financial position. 2. Improved transaction accuracy. The system's self-balancing mechanism helps identify errors and discrepancies, reducing the risk of inaccuracies. 3. Enhanced cash flow management. Double-entry bookkeeping provides insights into your cash inflows and outflows, enabling better cash flow management and informed financial decisions. 4. Simplified tax compliance. Section 10. Double-entry versus single-entry, a comparison. While double-entry bookkeeping is the gold standard, some businesses, particularly small ones, might be tempted to use the simpler single-entry system. However, this approach has significant drawbacks. Single-entry bookkeeping records only one side of each transaction, similar to tracking your expenses in a checkbook. While easier to implement, it lacks the accuracy, reliability, and insights provided by double-entry bookkeeping. Here's a table highlighting the key differences. Feature double-entry bookkeeping versus single-entry bookkeeping, transaction recording, both sides versus one side, accuracy, high versus low, error detection, easier versus difficult, financial reporting, comprehensive versus limited, scalability, high versus low. As your business grows and transactions become more complex, the limitations of single-entry bookkeeping become increasingly apparent. Section 11. Conclusion: enhancing financial accuracy and transparency. Double-entry bookkeeping might seem daunting at first, but its benefits far outweigh the initial learning curve. This time-tested system provides a clear, accurate, and comprehensive view of your business's financial health. By embracing double-entry bookkeeping, you gain valuable insights into your cash flow, profitability, and overall financial position. You can make informed decisions, minimize errors, and ensure compliance with tax regulations. While the transition to double-entry bookkeeping might require some effort, the long-term benefits for your business are undeniable. So, take the plunge and unlock the power of double-entry bookkeeping.